es estratega de mercados globales de eToro. Ben, thank you so much for having us a few minutes.
Thank you.
Ben, the resignation of Mario Draghi as the Italian Prime Minister raises the risk of a domestic political crisis in Italy. This only adds uncertainty in Europe. We've seen bonds spread widening and equities slump. How do you see the impact of Draghi's resignation in stock markets in Europe?
It's coming at a terrible time, as you say. So political drama in Italy is really nothing new. What is new is the context in which it is happening. To have this level of political uncertainty in Europe's third largest economy and potentially new elections in October at a time when, in the same breath, we're talking about recession, we're talking about a deepening energy crisis, we're talking about the European Central Bank trying to raise interest rates, and we're talking about fragmentation risk with government funding costs and bond spreads in Europe widening significantly. I think that is the significance here. It is pouring gasoline on a fire which is already burning pretty fiercely.
Of course, Europe faces growing risks of recession with the deepening energy crisis and, of course, the uncertainty of geopolitical conflict with Russia. How do you see the evolution of the energy crisis? We are facing a difficult winter for this year.
Absolutely. So the gas crisis is getting worse and worse. We have gas prices in Europe which are basically 10 times what they were a couple of years ago. We've obviously seen Germany move up to its second level of emergency. We have the Nord Stream pipeline, which supplies a lot of the gas to Europe in maintenance for the next few days, with a lot of questions as to whether it will ultimately reopen. And as you say, we are only partway through the process of building up storage for the winter months. So that is all the bad news. The slightly better news is that oil prices have been falling significantly. Brent crude prices are now at 100. That is well off those long-term levels. And so whilst the energy crisis, I think, remains very severe, the broader inflation crisis in Europe, which is much more driven by energy prices than it is in the United States, for example. We're beginning to see, hopefully, some signs of light at the end of the tunnel.
And meanwhile, the ECB, Ben, is set to raise interest rates next week for the first time since 2011 and announced plans to intervene in bond markets to contain government funding costs. We are talking about anti-fragmentation plan, and which scenario do you think has the market priced in respect this anti-fragmentation plan and about the interest rate hikes we are expecting from next week?
So I think the market is expecting at least a 0.25% increase in interest rates, and it's very possible we see more than that if the ECB decides to front load its interest rate hikes to try to get them in before a potential recession later in the year, and also to provide some support to the euro, which has just slumped to a one-to-one level with the US dollar, a level we haven't seen in nearly 20 years. And this is basically the biggest level in global currencies, and we're right on it right now. So I think the ECB will raise at least 25 basis points, maybe a little bit more, to give some support to the euro. And for the transmission protection mechanism, which is their fancy name for the anti-fragmentation measure, I don't think we're going to see a lot of details. I just think they're going to say, we are going to do whatever it takes to stop bond spreads from blowing out to a disorderly level in Europe. And I think the markets will accept that. And that is what you've seen so far. Even with all the uncertainty over recent weeks, you still have bond spreads in Europe which are below the peak levels of a month or two ago.
Ben, can we think in ECB raising interest rates in 50 basic points, not 25?
Yes, I think that's very possible. I think it's very possible. I think the consensus is 25 basis points. I think the risk is absolutely 50 basis points if they decide to front load the rate hikes to get ahead of a possible recession and to provide some support to the euro, which is very weak at this point.
Meanwhile, we are seeing a strong dollar, and we are wondering what impact does a stronger dollar have now on markets?
That's a very big impact. It's hurting commodity prices because commodities are priced in US dollars. It's exporting inflation. US has 9% inflation. It's exporting that inflation to the rest of the world at this point. It's tightening financial conditions in the rest of the world. The vast majority of international loans are in dollars, which now require more local currency to repay. So there's an awful lot of negatives, but there is a couple of big positives. If you are a European economy today, which exports a lot to the rest of the world, or you are a European company today, which exports a lot to the rest of the world, and there are a lot of both of those in Europe, the weaker euro is providing you with a little bit of extra competitiveness, especially versus US companies, which given the low growth and recession risks in Europe, I think is very welcome.
Thank you so much, Ben Laidler, for this analysis from eToro. A pleasure.
Thank you.
Nos quedamos, por tanto, con ese análisis.